All right, guys, we are live. And as promised, if you were watching our live stream last night, we wanted to bring to you what is going on with the Fed. So we're going to play some clips here, kind of have like a little reaction video. We definitely want to know what you guys are thinking as far as, what are your thoughts? The Fed just came on and said that they were keeping interest rates the same. They were going to stall. And we're just going to play a couple of the clips. Melissa, is this a surprise to you?
No, it's not a surprise. I think they're playing it safe. I think they're being cautious, and yeah, let's roll the video.
Yeah. So here we go, guys. We'll play a couple more clips here, but I cannot believe, I was afraid this was going to happen. And you can see, some of the comments that are already starting to come in. I mean, we are in a situation right now where, Wall Street had hit, the markets rallied yesterday because they knew this was going to happen. They knew that he was going to stall, which in my opinion is a sort of like a way of pivoting, right? I mean, they did go on to say, and we'll listen to some more here, but he did go on to say how, they would probably need to raise rates again. But I think this is catastrophic to let off the gas when we're still looking at CPI inflation year over year still being around 5%, almost three times the amount that the Fed is saying that they're targeting, that target rate. And as we listen, you'll hear where he says that we won't actually get down to that 2% until 2025. Now, the problem with this is that if you kind of keep things the same and you stall, eventually year over year prices are going to come down because they're just not going to go up from where they are right now, which is already way too high. So if I look at a house right now that is $700,000, right, way out of the price range for, median income buyers, right? You just say $700,000. If that home price has gone up 40% or more in the last 3 years, right?
Mm-hmm.
And we look at that and we go, well, that's okay. Let's just say it's a 20% year over year increase, right? Which it has been in the last 2 years on average. If we now just don't reduce that price and we just keep it at the same or only raise it over the next year 2%, well, then eventually we'll hit the 2% target rate, right? But there's no disinflation, there's no deflation, right? Basically, all we're doing is kicking the can, stalling things where they are right now and hoping that they don't go back to 10, 15, 20% year over year gains.
It's a scary time. I mean, I think it's just all, I hate to say it, political. I mean, there's too much on the line here, and they are saying that things are better. I mean, are they better? They're not better. Better than maybe what it was, but we are nowhere near where we should be stalling. We should be continuing to go at least by a quarter.
Well, I think that the devil's in the details, right? So it's what he's saying here is that it's price stability. So they're just trying to prevent prices from going up 20% a year. They're not trying to do anything to make it less affordable. But let's just listen a little bit more.
To expand at a modest pace. Although growth in consumer spending has picked up this year, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Have declined so far this year.
We can just kind of hold it right there because, basically what he's saying, and this is a big concern, and one of the things that we talked about on our live stream last night is that the labor market is weakening. We know that for a fact. We know that jobless claims have risen drastically over the last 30 days. In fact, you can find that on the Fred chart, and and Joe, actually, maybe you could just pull it up right now, but as we're talking about it, but the jobless claims have really shot up. And, the issue is here, in my opinion, and we either need to stay committed and stay on track to bring prices down, or we're just going to, foster higher pricing. Now, I mean, this is exactly what Wall Street reacted to yesterday in knowing that this was coming. And, and basically now we're going to watch people start to spend again, because they're going to look, and he says we're going to reserve the right to further rate hikes later this year. But the bottom line is that, you give people an inch, they take a mile. Now they're going to be saying, the news is going to take this and run with it. They're going to say, now's the time before we have any more rate hikes. Now's the time to go out and buy. Now's the time to go buy a house. This is kind of like the news the sellers were hoping for. So I think that we'll see inventory, start to increase now that we're watching the Fed, in my opinion, pivot off of laying off the throttle of, applying more pressure. The prices aren't coming down. The job market is still strong. We do need to see that weaken a little bit more in order for the businesses to feel the pain enough, from the more slowdown in economic or, growth or consumer spending. So when we are laying off the throttle in any way, shape, or form, we're basically telling consumers, keep buying, keep spending money, right? We're holding things where they are. And, in fact, Melissa, just the other day, I received something in the mail from a credit card company offering me 0% interest rates on money, on a transfer from one credit card to another for 15 months. And, so this is going to give all of the banks, and they knew that this was coming. Mm-hmm. And, you can't tell me that they didn't. They knew this was coming. That's why I just received it in the mail. And, so I think this is a colossal mistake.
Mm-hmm. It's hard to think this is not all orchestrated. This is not the time to be spending. I mean, it's a false sense of safety. And I think that we need to be smart. And I think that many are not going to be, and it's going to be, I see exactly what you said, Todd. The sellers are getting ready. This is what they've been waiting for.
100%. And I know we're lagging a little bit there, but let's kind of take some comments. Joe, go ahead and take that down, because I know playing it for some reason we're really lagging, and I don't want to bore the viewers. The bottom line, guys, is if you're just logging on, Jay Powell just announced that they are keeping interest rates right where they are. They're stalling. They are stalling. So it's showing me, that you can't tell me that there isn't some influence here, with, hey, we can't keep applying the pressures. The banks are starting to feel bad because, they've spent all the depositors' money that's out there in investments. And, if we keep jamming these rates higher, it's going to affect the banks because they're stuck in these lower interest rate commitments. So it will be costing them more money than they will be getting in income, with this kind of tightening. And then we're looking at, we already know that in 2020, the Fed, one of the Federal Reserve's jobs is to make sure that the banks have vault money or, some kind of a reserve minimum of, you collect, $1 billion, 10% of that money prior to 2020 had to be in the bank vaults, in the safe, so that when people wanted to go in, if we should have like a bank run, they can go in and they can take their money out. And we already know that minimum reserve was reduced to zero. And, there's articles out there right now, you can find them where like JP Morgan Chase, they have like 2 or 3%, not 10%. And I'm sure other banks could have even less than that of their depositors' money. And the reason why is that the Fed wanted to stimulate the economy back in 2020. And by reducing the bank's requirement of holding back 10% of their depositors' money in the vault in cash for a bank run, was because they wanted the lenders, these banks, to lend out more money to increase available debt to borrowers or to consumers. And we know that has ran up $1 trillion in credit card debt from consumers. We know that people right now are struggling. We just read yesterday and last night's video the information off one of the recent articles in Yahoo where we're saying that people just can't afford, median income families or individuals cannot afford to buy a house. The way to get the prices down is to keep cranking the rate. You got to keep cranking the rate because we know that this is what borrowers are depending on. They're depending on buying payments. If we back off rates and we pivot now, we're going to do nothing to this housing market but fuel it even more and expand the bubble even more.
I mean, Ashley made a very, very good comment here. I'm going to pull this in really quick. She said, we have to remember that summer is a tricky time with a lot of travel. Parents cannot leave their kids at home, so things have to be okay during this time. Can't curb spending during the summer.
How about this? How about we curb debt?
Yeah.
Ashley, I hear what you're saying, but how about we curb debt? How about we don't encourage people to spend what they don't have? Whether it's summer, whether it's fall, whether it's wintertime, whether it's the holiday season, whether you're gift buying, the bottom line is we have to curb debt. And the only way to curb debt is to raise the interest rates. You will curb the ability for people to accumulate debt, right? You will restrict the amount of money that's on the street that they can lend, right? Because money won't be cheap. So what we're talking about, the Fed overnight rate is what we're talking about, it needing to be increased. If you can buy money at 5% from the Fed and you can charge 12% to the consumer and make that money in profit by extending credit to them, right? How do you restrict that bank from doing that? You raise the bank's rate at what they can borrow money for. You raise that to 10%. Now if they have to mark it up to 20%, can a consumer afford that kind of interest payment? The answer is no, not and pay off the balance. That's where we are right now, right? So where interest rates of these credit cards, people are in debt more than they are $1 trillion in consumer debt. You have to stop people from getting into debt. The way that we do that is raise the interest rates. If we raise the interest rates, people aren't going to be quick to buy something that they can't afford. That's going to bring consumer spending down. And then that is going to reduce the amount that people can pay when they're walking in the doors to a business, right? We've got to slow this down.
Got to slow it down. What do you think about this comment? We got Todd H here saying the only silver lining is they didn't cut rates. People couldn't afford a house yesterday. They won't be able to afford it tomorrow either.
And Todd, you're right. You're right in a way here. I agree with what you're saying, but here's the thing. We are starting to sink in now that 6.5% or 7.5% is the normal, right? So when we start sending a message that we are done, and they may, they said that they were, reserve that further rate hikes may be necessary, but remember, they're trying to do year over year reduction in inflation. So the longer we extend it out, let's keep something in mind. Prices started crashing last June. All right. So if we take June to June, we're now at a year. From this point on, the CPI is going to be adjusted to a crashing rate of the latter part of last year. So now they're going to be comparing these to, see, the CPI is coming down because now we're going to compare it to October or August when prices were coming down or not increasing year over year after we hit like June. So what I think is going to happen is they're just going to say these CPI numbers are getting better, but we're not seeing any type of deflation. Unless they keep pressuring interest rates, we're not going to see prices come down. If people can't afford it now, you're right. They can't afford it now. They may not be able to afford it tomorrow, but we're not doing anything to bring it down. All we're doing is getting it into stagflation. This had just turned into stagflation. Prices are going to continue to rise. or stay where they are at unaffordable rates, and demand's just going to continue to drop. That's stagflation.
Make this a little bit clearer here, Todd. We got Nilufar. So today the Fed meeting is not good for a buyer, right?
I mean, it's not. It's not. It's not good. I mean, just like Todd H said, it's by stalling, it's just going to keep things the way they are. I mean, we've seen little inventory, we've seen a lot of demand, we've seen very little credit tightening, like they've talked about. We're still seeing people get houses with 0% down. They're not in any better position. They're putting less money down. We're seeing banks entice them, like Rocket Mortgage, giving grants and allowing them to come out of pocket 1%. We're seeing banks like Chase, giving free lock-ins, rate lock-ins for 90 days. Everything is just trying to encourage the buyer to just say buy, buy, buy. The only way that we're really going to see benefit is if the rates go up to a point that starts driving prices down. Because remember, price is the important part, not the payment, right? So if we truly can get prices to go down the other direction for a sustained period of more rate hikes, we're going to see these prices weaken. And then when you buy it, because the price has gone down at the higher interest rate, then you can refinance when things drop back down to normal. To refinance from 7% to 6% is not worth it. If we get our mortgage interest rates up to 9% or 10%, and then they drop down to 6 or 6.5%, now you're starting to see where, we've gained a good price on a house. We've chopped away at some of that 40% price gain over 2 years, that bubble. We've chopped away at that. And now we give the borrowers, the opportunity to refinance in a year and a half or 2 years when rates get back down into the 6% range. Just keeping it the way it is without further pressure. And I get it. It's not a political story that anybody wants to hear right now.
Well, now we're probably going to be running into FOMO because now everyone's going to want to beat it before they raise the rate again. And they're going to want to purchase, get in there, do whatever it takes before rates go up.
That's a good point, Melissa. I mean, think about it that way. They insinuated, kind of alluded to that they're going to raise rates, or they reserve the right, obviously, in the next meetings to raise rates, right? They're going to meet in July. I think they're off on August, and then September, they're back again. But when we're looking at something like that, we go, okay, just like you said, a great point. Now, hey, we better hurry up. Mm-hmm. We better hurry up and buy at this rate before rates go back up again. And I guarantee every lending institution is going to be playing off of that.
They're totally going to be playing off of that. And I expect more programs or different things they're going to be offering, incentives. Yeah, of course.
So what do you guys say? Well, let's look at some comments. What else are we seeing? Thank you for that comment. Not good for buyers. I don't think so. I think you're going to, just like Melissa said, there's going to be a ton of FOMO out there. It's going to be a lot of pressure for you guys to act now before the rates go up again. And quite honestly, as we get into this extended period of time, the CPI is going to look better. The jobless claims is going to rise up. I don't know if Joe ever got that jobless claims teed up for us, but that we showed last night. But that would be a nice slide, Joe, if you could get that going. But yeah, let's see what everybody else is saying here.
Yeah. Being out of debt is not luck. Planning is essential. I am so chilled, relaxed, even though the economy is such an Elm Street nightmare around me. I mean, that's it. That's being responsible with your finances. This is not, you have to work at it.
Yeah, well, we were encouraged to spend.
Encouraged to spend.
I mean, we were encouraged with such cheap money to get ourselves in debt. This is making the banks rich.
Yeah.
Here we go. Look at this. This is a great chart here because, and I think that this is going to get worse. I hate to say it, but if you look here at, the last month, really in this data chart, the jobless claims have really shot up. I mean, you can see where for the amount that it shot up in comparison to, a year ago, dating back, in March of 22, obviously we've gone up significantly in this chart, right? If you just look at the trend lines, but when you see the last month of data or the last really couple weeks in data, we've really shot up significantly in jobless claims. And I think that, that's why he's trying to soft land the economy, but I think it's not going to work. Ultimately, prices, I think we're going to see stagflation. I think we're going to see people get more into debt. This is going to be an opportunity for banks to make a lot more money. And thanks, Joe, for pulling that up. All right, what else? What do you guys think of all this?
Dan Amir, in the long way, a lot of people will be hurt when they lose their home value and can't refinance their home because of no equity.
And the people in the last 2 years, we've been warning them about that. I mean, they are going to see when we finally do see prices come down, which they have to. The people that bought in the last 2 years, they're underwater now. So it's true. But you know what? What were they thinking when they were outbidding people and spending $100,000 over appraised value in cash? How does anybody think that's a good idea?
Yeah.
That's insanity, right? You think about it. That's like concert tickets on steroids. All of a sudden you want to be in the first row because you want the thrill of being at the concert. But then after you spent the money with the scalper, it's a $200 ticket you paid $2,000 for because you had to be there in this front and center row. And now all of a sudden when you wake up and realize that you don't have the money and you don't have the value, this is what's going. That's why 74% of the people that bought a house in the last 2 years, up until June of last year, 2 years prior to that, 74%, it's been on multiple in multiple data slides, it's been covered. 70% of the buyers have some type of remorse. Remorse shouldn't be normal. If you feel remorseful about your spending, you probably shouldn't have bought it, right? I mean, what are you remorseful for?
It's
what
sad.
are we remorseful for? We're remorseful when we realize that we spent too much money for what we got. That's remorse.
Yeah. I mean, you've got, here it is. We have Wayne here. Wayne Smart. I'm putting off my plans till next summer either way. I mean, why not? If you can do it and you're not in a situation where you have to definitely move for a job or whatever, family situations, yes, take your time.
I think it's a good idea. Yeah, that's a good idea. I think people, if we feed into this and allow it to continue, this madness to continue, we've got to, as consumers, we have to take control. I think that the one comment about, it's no luck being out of debt. I think unfortunately, I think that this is going to teach a lot of people some hard lessons. And, and today, like I said, I'm very disappointed. I was very hopeful, and I know that sounds crazy, but I was hopeful that the Fed was going to stay on track, was going to continue to raise. The numbers are not that much better. This is insanity, guys. If you look at 5% or 4.9 or 4.8, whatever percent of CPI, which is really a ridiculous calculation or way to, evaluate the state of our economy. It's insanity. They take out, things like housing. They take out things like, utility costs. And when they're adding this in with things that are way off the scale, because if they added them in, we would all be sitting around going, what is wrong with this picture? But when we're splitting hairs and saying that the economy is doing well and when we haven't seen it change much from month to month, we go from, we got to continue to put pressure on it, but nothing's really changed.
Yeah. What do you think about this question, Todd? Do you think these people really believe they can kick the can down the road for another year and a half until elections?
They're going to dump it on whoever is in office in 2025, right? When they get inaugurated, they are going to realize that they have adopted and taken on this massive everything bubble that absolutely has to collapse at some point.
Yeah. Yep.
It has to. Where does it go from here? Is this the bubble that just keeps on growing? Does it continue to get bigger and bigger and bigger and bigger? And we've never seen it before. We have never seen housing. But Joe, pull up the median household price in the U.S. I mean, when we look at this chart, every now and then I just have to pull this chart back up because I start to second guess myself. We're in a population decline, right? We're in an immigration incline. I mean, we have more immigrants coming into the country. I think that's the only thing that's keeping the numbers, up. But we're in a population decline from, American, growth, population decline. And we have houses. Many people own 2 and 3 houses. They own, short-term rentals. They own all these, vacation rentals more than ever. We have a situation where more single people are owning houses. That never happened back in the day. You had multi-generational households. You didn't have one person buying a single family house that's 3,000 square feet for one person or 2 people. Right. So we've been building McMansions. We haven't built any affordable housing. We start taking all of these things into consideration, right? On and on and on. And now all of a sudden we look at this chart here. And every time I look at this chart, I just shake my head and I'm in disbelief because through the history going back to 1964, when we're looking at the housing markets, decades, and we look at the housing market, look what happened in 2020. Now, come on, this is a phenomenon. All of a sudden in 2020, we didn't have enough houses. Really? And all of a sudden, we woke up one day in 2020 and said we have no inventory. We don't have enough houses in the U.S. One year, the demand and the supply and demand went that far off kilter in 1 year. No, what happened was they made cash free to escalate everything, to stimulate an economy. Guys, look at the gray lines on this chart represent recessions. In 2020, it was a brief recession for the pandemic. It is the tiniest recession that we see on this chart, going back to 1964. The longer, the wider the gray bar, the greater the recession. We didn't even let things get bad.
No.
Now, I'm not talking about medically or a pandemic, and I'm not making light of that. I'm not talking about that. I'm not saying that it wasn't bad. I'm not saying that people didn't lose loved ones. I'm not talking about that. I am talking about the fact that we stimulated this economy so fast, more than any other time in the history of our country. We printed more money in 2 years than we did in 200 years. Why? Why did we do that? Right? So look at the chart right here, guys. This is the median sales price of houses sold in the United States. And you show me on this chart where anywhere dating back to 1964 even remotely resembles from 2020 to 2022. Please, somebody fill me in. Let me know where did we go wrong? 40% increase. Now we're looking at something. You see that sharp arrow down? Now, what do we want to do with that? We just want to let it go back up again?
God, let's hope not.
It blows me away. Anyway, let's see what's everybody saying. Oh, Todd, you're crazy, right?
Got sneaky deals. First-time home buyers can't put a lot down using an FHA loan, escrow account that banks can force buyers to pay more a month to avoid losing, going underwater. People are not talking about this.
Over 1 million people, thanks for this comment, over 1 million people have taken advantage of loan modification programs. These are not people that just bought in the highest, fastest bubble in housing. These are people that bought prior to 2020. Okay. Majority of these people are not new buyers that bought at the height of the market. We haven't even seen that yet. We haven't seen the results of that yet. In 2022, President Biden, part of the American Rescue Act, gave the states the authority to pay the mortgage moratorium finally ended, right, from 2020, where people could stop paying their mortgage payments and the banks will work out loan modifications in many different forms, right? And so what was happening is that was coming to an end. And that's when the American Rescue Act went into effect. That basically, I know in Maryland and in many of the states, it's still available. A lot of the money hasn't dried up yet. And if people are having housing related payment problems, paying their mortgage, paying their insurance, paying their taxes, housing related expenses, in Maryland, it's up to $50,000 per borrower, per household, that they can get money still to pay their mortgage payments. So not only did we drop money to zero, stimulate the economy, print more money than we've ever printed in the history of the U.S., we allowed prices to run completely out of control to the price that people can't afford things, right? We're knocking out the middle class. We're making the middle class, just deleting it, right? And you're either wealthy or you're below income standards or below the ability to pay your bills. That's it, right? We're thinking now, like, how do we do more stimulus? How do we do more bailouts? How do we provide trillions and trillions of dollars in case banks collapse and can't afford to pay the borrowers the money that's theirs in the bank? We don't do it by dropping the reserve or the requirement think about this. If you give me all of your money, and that's what people do, they give the bank all of their money. They put it in the bank, right? They're not putting it in their mattress. They put it in the bank, right? All their money. And if you knew that they didn't have to keep any of that on the side as a protective measure, because the Fed, the FDIC is going to finance you up to $250,000, they're going to pay you back. They're going to insure you, not finance you. They're going to insure you. And then all of a sudden, that's not even the case anymore because you go, oh my gosh, guys, we can't. Did they wake up one day and realize that $250,000 wasn't enough? Did they just realize that? Well, we reduced the ability for the bank to actually be fiscally responsible with your money because we let them spend it all to offer credit to people to get them into debt. And now we're going to raise the rates, and now people can't afford to make the payments. They're going to start defaulting as they are. Where does this make sense? Please help me. Help
Dustin,
me. Where does this make sense?
Try to calm Dustin down because he's concerned here. So me and my girlfriend just bought a home last week. It's a home that should have sold for $525 to $550K. We got it at $450K, put $100K down, praying we're okay.
Yeah, I mean, you sound like you're okay. It sounds like a good deal. I mean, if it should have sold for $525 to $550, and you're talking about a 20%, almost 20% reduction, in price, I mean, you should be okay. What I would say, Dustin, is, stay put, stay put. Hopefully you can put some sweat equity into it. There's a reason why you got a good deal. You put a lot of money down. Hats off to you. You have skin in the game. Hopefully you could afford that payment. And, we're not seeing that in the comment that, what your debt to income ratio is and, your affordability beyond that. But if you're looking at, if you needed to fire sale the house, I would hope that looking at something in this price range, just this simple analogy, not knowing much of the details, if you were to get yourself in a situation where you had to sell you're probably okay. You need about 10% of equity in a house, about 10% of equity as a nationwide average, some a little bit less than that. By the time you pay real estate commissions, transfer recordation fees, go through any home inspections, deal with maybe a repair or two. So you want to have 10% equity before you put the house on the market so that you can come out without, now you have equity in the house based on your down payment, but that doesn't mean that you want to come out of pocket, should you need to sell. But it sounds like you're all right.
Kevo made a very good point here. I honestly will feel bad for the ones who buy today at 49% DTI, barely qualifying for the home loan, then a reduction in pay or increase in inflation takes them out financially.
100%. 100%. Yep. I mean, and look, we're 49%. We're seeing people finding themselves in a situation where they're 60%, because let's face it, when somebody wants something really, really bad, they cinch in their belt, right? It's like me when I'm trying to lose weight, right? I mean, it's like I will go through a period of time, like if I want to lose a lot of weight fast, I'm going to go through a period of time where I stop eating, and I'm going to achieve that goal, right? So I'm going to stop eating and I'm going to achieve the goal of being able to cinch in my belt. But eventually I'm going to get back to life's, issues of me working all the time, not having time to work out. I mean, it's just life happens, right? And now all of a sudden I'm going to get back to the realization that, I sucked in my, cinched in my belt on something that wasn't sustainable. I know that sounds like a crazy way as an analogy, but, let's think about this. So you want to buy a house and you talk to a loan officer, and the loan officer is going to say, Todd, you're getting ready to buy a house. There's a couple things that I want to make sure that you know of. Don't buy anything. Don't spend on your credit cards because we got to keep your debt to income ratio. Put those suckers in the safe for the time being, right? Don't buy a car. I know your car is falling apart. I know you need to get to work, but you've got to wait until after you buy the house before you buy the car, right? Don't go out and buy furniture and get enticed into the 90-day same as cash. Don't add debt to you, right? But you're sitting there saying, okay, I'm going to do this until I buy my house. So now my debt to income ratio is one thing because I stopped spending, right? I stopped eating so I could lose a couple pounds. I stopped spending so that I could get into my house, not realizing I still need the car when I close. So now I've got a $500 or $600 a month for 7-year car payment that's coming right around the corner the minute that I buy my house, right? Or not realizing that when you buy the house and something breaks, you don't have the money for it. And now you have to go, your debt to income ratio is going to go through the roof because you're going to put $15,000 on your credit card to replace the heating and air system in the house. So these are the issues that we're going to see unless prices come down. Unless prices come down, which is a mistake by laying off the throttle, in my opinion. It's out of my pay grade. I'm not the Fed, right? I'm not even a Fed employee, right? Because now I won't go there. The issue is when we're looking at this thing, guys, is that I'm seeing people right now, contractors. I've been a contractor my entire adult career. I started when I was a kid. I started swinging a hammer in 1989 for myself. I've been a builder. I built houses. I've rehabbed, you name it. I've worked for other people. I've contracted residential, commercial. I've developed land. I've done the whole gamut in this industry. My point here is that if I call a contractor to come and put a fence in my yard, I am going to get a stupid number, right? Because people are just putting whatever prices on because they have zero pressure. There's zero pricing pressure, right? I'm not saying that contractors aren't entitled to make money. I'm not saying that businesses aren't entitled to a profit, right? What I'm saying is that we are not putting enough pressure, in my opinion, or squeeze. I know everybody in our area, in every industry. I can walk in and talk to them or pick up the phone and call them and say, how is business? And they're going to say, unbelievable. I mean, it's crazy. I know all this news and talk, we shouldn't be doing this well, but we're still busy. Sales may be down a little bit, but we're still 100% over where we would have been year over year 2 years ago. That's what I'm talking about, right? We're not letting this sink in fast enough and hard enough that is changing these indicators that prices will come down. That's the issue here, right? And you guys know it. You know it. You know it yourself. I'll tell you something else too. It's kind of off track, but we are becoming very complacent and expectant that other people are doing it for us, right? That we're just getting along because other people, we don't have to worry about this. Everybody's doing it for us. I went to the grocery store the other day, and I had been shopping, doing some things, and I'm a terrible shopper, and I'm helping somebody out, and an elderly person, and I'm doing some shopping for them. Okay, so I'm kind of putting myself into an environment that I'm not used to being in. I haven't shopped in years, but over the last couple of months, I've been doing it. So I go in the grocery store, and I'm picking up things, and I'm trying to be mindful because it's not my money. I'm trying to be mindful of what I'm buying. And I'm checking out, and I'm ringing things up in self-checkout, and I'm going, I don't remember that price being that. Like, it was less than that on the shelf. Well, then what I did was the next time I went back, I started taking note to things, right? Now, I don't have time to go flag a manager down. My gosh, there's like one employee running 18 checkouts, right? I mean, it's ridiculous. No help, right? Or, these people, whatever, they're on their phones or talking to their friends. My point is that when I was ringing it up, I was like, I'm right. This thing's priced wrong. This product's priced wrong. Now, it may only have equated to a couple of dollars, literally, not worth my time bringing it to somebody's attention. But do that to yourself. Pay attention to it. When you go to the store, see if this is happening to you. I'm thinking to myself, there was a time back in the day where I would have said, hey, time out, man. But these businesses aren't being held accountable to what's going on. Maybe the prices change so fast and they don't have the people to put the right prices on the shelves. I worked in a grocery store when I was a kid. Even when, you get your work permit, before whatever, however old I was, 15 or 16, whatever. And I worked in a grocery store, man, and I know they had a nighttime crew and a daytime crew and a this crew and a that crew and everything crew. But my point is that we don't even care about what the prices are. We're just going in the store and buying it, right? Guys, we're getting jacked up here. We're getting jacked up here.
I did want to, this is a good comment, and bear with me a second. I just got to get to the next screen here. A valid point. So you've got the backyard homestead. There is a lot of latency in the inflation data. You yourself have mentioned this delay. You have to give the previous rate hikes time to have effect, or you will grossly oversteer.
Yeah, and we've only done 1/4 point increases, right? We haven't been doing 0.75% increases. So we still haven't changed much in multiple months. Right. So, I mean, I hear what you're saying, and you're right. There we're looking at backward looking data all of the time. But I'm looking at current data when I'm looking at the housing market right now. When I'm still looking at house prices that are out there, I'm going, you got to be kidding me. Right. I'm looking for somebody in the $250,000 price range. And, in Baltimore County here locally, which is probably one of the most affordable counties in our state. And I'm looking at $240,000, $250,000 houses. And let me tell you something, man, you don't get much, right? We're talking about houses that sold for, 2 years ago that sold for 150, 160, 140 to 160, right? So we're looking at it going, okay, the prices still haven't come down to where they should be or what people can afford. And these are houses, man, that haven't had a kitchen upgrade since 1970. Right, their bathroom has pink tile, teal green, blue tile, blue tubs. we're talking about people need to go in and do massive renovations. I was in a house the other day. I couldn't believe it. Melissa, you were in the house with me. And I went nuts, right? I'm a contractor. I know what to look for when I'm going in a house. What was I finding I couldn't find, Melissa? Do you remember?
The electric panel.
Electric panel, yeah. I
Yeah.
was putting you to the test. So it's not scripted. So, couldn't find the electric panel. I'm thinking to myself, I saw a panel in the basement. It had maybe 4 double tap breakers. A double tap breaker is a breaker where you don't have enough room in the panel. And so you put a breaker in. It's got 2 little, teeny weeny switches on them instead of one like thumb type of switch, right? It's got 2 where one typically is. That's called a double tap. We don't like that. That means that the house is out of power when you start double tapping breakers. But we found that one in the basement, but the breaker itself said 40 on it, the main breaker, right? You got the line that comes in and it says, it feeds it. And the top, the big disconnect breaker said 40 amps. I'm like, I'm looking everywhere. The only thing I didn't do is climb underneath the house. I'm like, where's the electric panel? This cannot be it. Well, sure enough, it's it. We got a house with 40 amps coming in from the street. You can't, let me tell you something. If you're blow drying your hair and you turn the microwave on, you're going to blow a breaker and be in the dark. So don't blow dry your hair during the night hours, right? When it's nighttime. It's crazy, right? So this is a house, hundreds of thousands of dollars that someone's going to have to go in and do a massive power upgrade and pretty much rewire the entire house, right? So these are the kinds of things that we're seeing in these price ranges that people can't afford. We're doing nothing to put more pressure on. But you're right. I mean, we're looking at latency, backward-looking data. I'm 100% in your camp on that. I do believe it. But we have seen that not a whole lot has happened in many, many markets. We're starting to see it now. Now is not the time to let off the throttle, right? Because we haven't seen enough of it. So we're a year in. Now is not the time to pivot. And I think not raising rates is a pivot.
Mm-hmm. They're saying,
Don't plug
Melissa,
your laptop into Man, I love this.
Oh gosh, you guys are so fun. I love it.
All right, pull that up because a lot of people may not even know what we're talking about here.
My laptop?
If you got, no, not your laptop. The comment there, so
the
everybody we can kind
comment.
of explain what we're talking about. People are like, "What the heck are you talking about?"
Oh my gosh.
So this is a very loyal follower, and we appreciate you so much. But the funny part about it is in our live stream, somebody had made comment to Melissa, "It's covering the whole picture up right here. Your laptop is." I mean, it's that gray bar across is not. It's not part of the building falling down. That's actually her laptop. It's ginormous. You can store small animals inside of it and things like that. But anyway, somebody had made a comment about her laptop and we ran away with it. And now you guys are commenting like it should be the next thumbnail. It should be laptop should be holding the house up. It should be weighting it down.
And we just had a super cash chat as well from the Duke that says, Melissa, where can I get the giant things? They're referring to my laptop and my
Duke, we love you. We thank
water.
you.
So thank you.
Great,
thank you.
Loyal follower.
You can get it online
all the time.
Yes.
Yep. Get it online.
Get it online.
Right.
Yep. That's so funny. But there was a comment here, Todd, I wanted to, because we did talk about how lenders and builders are going to be coming up with incentives here with the pause. You got one right here from Katie. I just went to a builder today offering 4.99 interest rate on a $350,000 home.
Yeah, and just be careful, Katie. Make sure it's not an adjustable rate mortgage because we are seeing where builders are offering that. And, I ultimately think, look, I'm staying true to what I said. I think that the reckoning is coming. You can call it a crash, you can call it a correction, you can call it whatever you want. We're continuing to just kick the can down the road. We're not the only, tools that we're using right now and we're playing with is, the interest rate. We're not doing anything with government spending. We're not doing anything about, eliminating, bailouts and things that are just continually enabling people to not be responsible for their spending actions, their spending habits. And look, this is happening. We don't teach financial literacy in school. It should be required. By the time you're 15 years old, you should start to be learning about money, right? And, if, and I'm not getting into the parenting aspect of it, I'm just saying we need to teach our youth about the consequences of money. And, none of us want to let the way it was when I was a kid. I didn't have this. I walked to school in 3 feet of snow. And now the bus guys picks you up at every single driveway because, God forbid that we can walk, 500 yards to the bus stop, which was what it was like when I was a kid. I was a walker. I had 2 miles to walk thereabouts, and I was a walker, right? It's not, you say, well, you were old, you're just you need to get with the times. Well, guess what? Maybe we should get back to those times. We should start, teaching consequences for our behaviors and our actions and misspending, and we can't have it all, despite what your friends have. And that's a hard lesson to learn sometimes. But you know what? That doesn't mean that you don't have opportunity. It's a temporary thing. If I teach you or can instill in you good values to where you can't have it now, but you can have it later, and I give you ways to be creative in your, in the way that you can get there, you're going to feel a heck of a lot better about it when you get it. Right? I mean, we all know what we've worked for, and when we achieve it, we're like, that's cool. That's a good thing when we're the dedicated people. Everybody, and another thing, I mean, along the line of that, you can't have, a 10th place ribbon. At some point, it's not fair to the ones that are in the first place or the third place, right? Because you can't just say, oh, well, you tried. No, you didn't try. You didn't try as hard as the guy that got third place, right? You have to know that there is a process, and to get there, you have to build up. You just can't go from one level to the next because somebody gives you a credit card, right? You got to get up with something that's sustainable.
Mm-hmm. I have a question here from the Duke as well. We're getting ready to make an offer. How will the Fed rate today affect mortgage rates before we get to close?
I think you're going to see where people are going to run with this big time. We're going to start seeing incentives. I believe that we're going to start seeing incentives. Just look again at how the markets responded yesterday. I think the highest in, was it 12 or 16 years? It did, it was like did really well. And leading up to this Fed's announcement, which, they knew what the heck was going to happen. Mm-hmm. I mean, they take these polls and they nailed it 100% that the Fed was going to stall. So we didn't really need to wait to today at 2:30 to find out what happened. But my point is, here with your comment, is that I think that you will see where there will be incentives in mortgage. I still think that we're not going to see 5%. I think we're going to be in the sixes, where we should be in 8. I know, Duke, you don't want to hear that, but that would help you get a better price on the house. But I think you're getting ready to make an offer. If you have a house picked out already, please make sure that you get a home inspection. If they're not permitting you to do that, I don't recommend that you buy it. Number one. Number two, make sure that it's location, because if you are buying in a higher price range or at the top of the market, that's okay. If you can afford to do so, just make sure it's in a good location. You're happy with the neighbors. Look over the fence, make sure they don't have a junkyard going on, because you can't control your neighbors. And I see so many people get upset about their neighbors. And in fact, I see a lot of people put their houses on the market because of their neighbors. It's not like a fact that you have to disclose. Well, my neighbor, I'm moving because my neighbor's 18 dogs bark, 3/4 of the night. But just make sure that you're looking at a lot of those, extra things that you should be considering when you're making a big buying decision. But and look for the best deal. If you fit in a box where you have good credit, there aren't any surprises. Shop your rates. Don't just take one lender's advice. You're allowed to shop, and from what I understand, talking to lenders, I haven't bought anything myself that would affect my credit. But I think you are allowed a certain amount when you're buying a house, a certain period of time where, having these inquiries on your credit report really is acceptable and doesn't really drop your score that much. Check with your lender about it, but see what everybody's offering and try and take the best deal is what I say if you're going to do it. Yeah, definitely.
Talking about the market, Todd, we get David Kaplan. What's the best way to do a quick market analysis on a potential house on your own without a realtor?
Yeah, that's a great question. You can go to any of the public-facing sites and find that data, whether it's Zillow, Truly, Realtor.com. And the biggest thing that I do, and I give you an example, it just helps somebody out of state. They inquired, they said, hey, could you give your opinion on this house? In fact, Melissa, we got another one that just came in from last night. We need to address them on a private level. So if you could just make a note of that. Remember last night I said, hey,
I do.
email me your situation. And they did. So I want to make sure we respond to them today. But anyway, so what happened was they have an agent and they reached out to me and they go, okay, look at this deal. How do I analyze this deal? Am I getting a good deal? I'm getting ready to put an offer in. Well, what happened was I actually got on the phone with the agent. And, when I went to Zillow, because I don't have the MLS data in this state, they break it down. It's subscription based. You got to pay as an agent. If I had all 50 states, it would probably, and all the jurisdictions in the states, it'd be $120,000 a month to have the realtor intel at my fingertips. So I have to go to Zillow and Realtor.com too. I personally prefer Realtor.com. I think it's an easier site to navigate. I think that Zillow's messed with their site so much that it's just complex to me. I'm a simple guy, right? I like simple data. But what I did was I got on and I said to the buyer, I said, did you know that this house had been on the market before? And when I looked at the history, and you got to expand it. So when you're looking, you have to expand the history on the property because it's only going to give you at a glance a couple of the most recent, or maybe no recent transactions. You have to expand it. But I said to the buyer, I said, did you know that they've been trying to sell this house since the fall? And they said, no, we had no idea. I'm like, you have an agent? Yeah. Okay, well, the agent didn't say anything to you about that? Nope, nothing. Did your agent tell you that this house fell through, went under contract and fell through? No. Agent didn't tell me that either. And this is a problem, right? So, when you're looking at David's comment here, you have to, if you have the wrong agent, you have to do your own research. But the first thing I want to do is I want to see what is going on with the property, right? I want to see when it was bought last and what was the price, because I want to have some kind of understanding. I can't necessarily see at a glance that they got a home equity line of credit and they jacked the debt up on the house. But if I can look at their price, their purchase price, and the time since they put on the market, I can kind of tell a little story. If it's 2 years ago, I'm thinking to myself, well, they're getting out. They are getting out because they can't afford it, or they're moving suddenly, or something's going on. Well, I know the chances are if they bought it 2 years ago, they're underwater, and it may not be worth it for me to even take a shot at the house. It's a conversation, not a contract, because if what I'm willing to offer them isn't possible because they'd have to come to the table with $40,000 in cash, that's telling me a lot about the story. But if I'm looking at somebody that bought 9 or 10 years ago, and I'm looking at the purchase price, and I'm like, man, they've got at least $200,000 in equity. And then I can look and say, well, they tried to sell it 3 times last year and it never closed. And then I can look at it and say, and it was just recently under contract in January and it fell through and then went back on the market. And I'm looking at it and I go, well, the days on the market, because it's June, isn't reflective of all this because they let 90 days go by before they relisted the house, and the MLS reset the days on the market. So now I want to do that, right? I want to study that and say, well, they try to sell it. Maybe now they even have it priced higher than what they couldn't sell it for back in January. So, when you're doing this data, this is giving me good intel on this specific property. Now what I have to do is I have to draw a polygon and look at the closed sales. So you can do it in any of the sites, Zillow, whatever. You can draw a polygon. You can switch it from actives to pendings to, coming soons or sold. When you select sold, because now we want to see, what were the prices in the last 60 days or 90 days, right? I don't want to look back like an appraiser at back to 6 months or look back a year, because that's going to tell me a false narrative to before the market started to shift and before interest rates doubled or nearly tripled, right? So that now I want to draw a polygon. And here's the thing, David, and anybody else that is paying attention to this, that's interested in it. You have to make sure that you're looking for properties that are in that same subdivision, because you can't cross major intersections. You're in different subdivisions and completely different comparables. So when an appraiser is looking at appraising a house, they want to see a couple of houses, a couple of solds in that subdivision. They'll take one outside of the subdivision, but they're trying to get at least two or as many as they can within the subdivision, because typically it's the same builder, same type of floor plan, same square footage, same neighborhood characteristics. And so you have to be careful. So if you jump across the street and you don't have the privilege, you're relocating, and you don't have the privilege of knowing the area, and you're depending completely on a real estate agent because you don't have time to go and spend weeks there and drive around and understand the different dynamics in the community, you can get hurt. So you want as narrow of a polygon as you possibly can to grab the data and don't cross those major intersections. So, I mean, they're, on the, sort of like the onset of the question, that's the best tips that I can give you in starting out. Understand the history of the property, then get into analyzing the community and compare it to things that are typically, when you're looking at comparables, you're adding and subtracting to the comparable to get to what your subject property is, right? So in other words, if the comparable has a pool, you're taking the pool value off of the comparable so that you're kind of bringing it more in line to your subject property, the property you're looking at. Same goes if you're looking at the number of bedrooms, the number of square footage. Don't make the square footage price mistake. You can't just say, well, I had an agent that was doing that to me the other day, and they're going, yeah, but this is $160 a square foot. And I'm like, I could care less about the square foot price. I mean, you're telling me we're not comparing apples to apples here, because one house has been completely renovated and one hasn't. So when you're giving me square foot price and telling me that my client's getting a deal, they're not, because we're not comparing apples to apples. So we really want to look fundamentally at properties. We want to add and subtract to the comparable. So if the kitchen is dated and hasn't been replaced in 30 years, I'm going to take off of that comparable, because that's going to get it more in line to where the subject property should be priced. Don't go beyond, in my opinion, don't start going beyond 90 days. When you do things like this, it's a different climate, completely different time. When we get beyond that, I want to see things that are recently. I want to see recent activity, things that are happening recently in the community, in the subdivision.
Mm-hmm. I want to backtrack for just 1 minute, because Katie did respond talking about the builder with the low interest rate. She did say, Todd, I appreciate your input. I believe I will wait. The offer sounded appealing. Therefore, my feelings got engaged. She's very smart noticing that. And then, however, waiting will make sense.
I don't think, so here's the thing. What we have to, and I don't know, Katie, I mean, it always makes me nervous when people are taking me for, in context. We have to contextualize the scenarios, right? But what I don't believe, in my personal opinion, that we're going to see if you don't buy now and we don't see prices come significantly down. I have a hard time believing that they're going to go significantly up anytime soon. So that should back off the element of pressure, in my opinion. You listen to Barbara Corker, and we just posted a video responding to, Barbara saying, if you don't buy now, you're going to be sorry in a couple years. And then Elon Musk is on the backside saying, oh my gosh, we got a major real estate correction going. Who do you listen to? What's the opinion? If nothing else, and you're becoming more prepared financially, you're in a better position than where you are right now. If you're feeling something that is saying, uh-oh, your uh-oh button is going off, doesn't feel right, we should be listening to that, right? We should be paying attention to it. Mm-hmm. Yeah, what else we got? We'll take a couple more comments and we'll jump off. But guys, we just wanted to be one of the first to bring you the JPAL. It's all over the news right now. If you guys are just logging on, JPAL stalled. In my opinion, it's a form of a pivot. I think we're just candy coating a situation that, in my opinion, we are just as worse off right now as we were 6 months ago. Even with the lags and things like that, we're still not seeing the affordability where it should be. If anything, we're seeing people waking up to the fact that they made decisions that they wish they would have waited on. Katie's saying she's going to wait a little bit longer. If you're in a position where you can do that, Katie, I think you're not going to be upset. You're not going to be upset for waiting. And here's another thing I'll just say. What I always say to people when they're doing the price game in their mind, right? You have a price that you want to buy something at. The seller has a price they want to sell something at. And now there's a big, it could be miles apart at this time, right? Because it's based on your affordability. But let's just say you're getting close. And the price is coming down to where, it's out of your comfort zone. Number one, analyze. Are you at the tip top of your comfort zone? When you're stretching, are you at the tip top of your comfort zone? If you're not at the tip top of your comfort zone, then, it's okay, right? Maybe you walk away at that point. But what I see buyers doing is they're like, man, I know I'm at the outside of my comfort zone, but I really want it. Right? You really have to get back to the fact of, are you nervous to the point that it's keeping you up? Like it's consuming your entire, I really want it, but I'm concerned. If that's the case, back off, because you're feeling that for a reason. It's not right. Because if it was right, you wouldn't be questioning it. Don't make the decision based on, will I lose $10,000 if prices drop? Make it firmly on, because it's hard to time any bottom. Make it firmly on, can I afford it comfortably? Mm-hmm. Do I feel like I'm making the right decision financially? Right? If you want to buy now, that's the way you have to think about it. Do I think that prices are going to come down? Still, I do. We may see a little bit of reversal where prices jump up after today's announcement. We may see more inventory hit the market. Keep in mind, it's summertime. It's still not the best time. We passed the best time for sellers to get the highest price. Historically, June, from this point on, prices go down till next spring. Spring prices go up. Rest of the year in a normal market, prices are down.
Well, that comment right there, talking about housing prices coming down, that's a perfect cue up for this next question. We just sold our home to downsize. We're retired living in an apartment to see if housing will come down so we can pay cash. Do you think housing will come down as interest rates won't affect us?
Cash is king. Cash is king. It trumps everything in most cases. I talked last night about somebody that I know that had put their house on the market, got a contract. It fell through. It's a new series that we're pushing out called Highest and Lowest, where I travel around the country and to different cities and bring you the highest and lowest prices of what you can, not literally the bottom or the top, but the ranges, highest and lowest price ranges for single family detached housing from a home buyer's, owner occupant buyer's perspective, not an investor, and what you can get for your money. And there was one of the sellers had gone under contract the night before we were shooting the deal, and in Florida, and the house went under contract, and the seller, very, very nice, said, I'm concerned. The buyers had remorse, and she said that it was a first time buyer. They needed financing, and she was concerned that it would fall apart, and it did. Thank God, for everybody involved. It's back under contract, and hopefully it's going to close. But my point is, cash is king. If a seller is thinking they're dealing with financing or renovation loans, or will it close, will it appraise, will it, and they're looking at anything that can happen, and then you're a buyer that's going to walk in and say, look, I want to know by tomorrow at noon, this is my price, excuse me, and I can close in 10 days. Now, you may be prepared to let them stay in the house for another 30 days because they may not want to get out in 10 days, but you're giving them an access to their money in a very short period of time. Now, let me ask you this. If you're a seller and you have equity and you're watching the news in the absence of today's pivot, in my opinion, you're going to say to yourself, man, I tell you what, this offers $10,000 less than what we've got, but there is no risk that this thing is going to close because we don't need an appraisal. We don't, unless you want an appraisal, and somebody's going to write us a check, and we can either be gone in 10 days or we can stay here for the next 60 days for free if we take this deal, $20,000, whatever it is, right? Depending on the price point of the house. We're seeing where sellers are like, take the cash. Take the cash. Let's take the money. Let's take the guarantee and run with it. And I was talking to somebody in Georgia, same exact scenario. They're looking at the offers and they're going, man, this one's got a contingency period. It's got blah, 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 blah. This one's complete cash. This is over $1 million house. Cash. What should I do? I said, if it were me, I'd take the money and run. So I think that you can get better deals in this environment because interest rates aren't going back to 4% or 2.75%. I would hope never, but at least in my career, I hope it never happens because I don't think I can go through it again. Emotionally, freaking getting beat up left and right with, writing 25 offers to try and, get a, experience buyer fatigue like I've never seen before, where these poor buyers are like, man, I'm not even taking my kids anymore because they're picking bedrooms and we never get any house no matter what price we offer. We're always getting beat out. That was a result of 2.75, 3%, 3.25% mortgage rates. Mm-hmm. I hope we never go back to that craziness. But I think that we're going to end up somewhere in the 6s or 7, mid 6s to mid 7% as a long-term mortgage rate. I think that as things normalize, if we can see a housing correction, that's a healthy mortgage rate. I hate to tell you.
Yeah.
So, I mean, to get back to this, I would look, if I'm downsizing and I'm going to my forever home, or the next, home for a period of time, and I have cash, I know I have flexibility, I know I've got some time, I know I can wait to get what I want. I'm not going to play into this FOMO. I mean, you're smart, you bought houses before. I'm going to stay in the apartment and not stress about it, right? Until something comes along that I'm really super crazy about. I either love it like nothing else. Like I can only see myself, the balcony is a perfect view, the perfect sunset, the perfect whatever. If not, my money is, not going anywhere until I get what I want. And then, I'm going to strike and try and make a deal with cash being king.
Sounds good. All right, Todd, we have time for another one.
Sure, let's
Okay.
do another. Why not?
All right, awesome. So we've got from Tan, Todd, is it a good idea to buy land then build a house on it, or is it better to do it the normal way, just buy a house? And would it be less costly or more costly to buy land and then build a house on it?
You know, the only thing that makes me nervous about you buying land and building a house, and from a builder's perspective, because I've built houses before, is that it's very risky dealing with builders. And, you know, there are a lot of good builders out there, but when you're talking about buying a scattered lot, right? Land, it's a scattered lot. You're not buying in a new builder community where builder tie-ins where you have to use that builder, Lennar, or what, you know, whoever, you know, whatever builder, right? NV, whatever it is. You're buying a scattered lot, and now you need to find a builder to build the house. Your safest bet, in my opinion, is to buy a modular. The modular builds are pretty good. Now, I mean, you know, it's hard to tell that a house is a modular house. It's the least riskiest, you know, as far as getting everything under structure, getting it dried in, all the major components. Because a lot of these modular builders, I mean, they put everything in just about except the floor. The drywall, or the electric's in, the plumbing's in, the drywall's in, the kitchen counters, cabinets are in, they're set. The only thing they haven't done is put the granite on. So when you get it set, then you have a couple of these other, and we got a great video on modular homes. If you're on Sachs Realty and you search in Sachs modular, you'll see a great local builder here. That, as a matter of fact, he's going to be on our Tuesday night podcast, upcoming podcast. Chris Seymour, he's a modular builder. But what happens is the builder does more, the whole modular company does the entire set, right? So your builder only has to get your foundation ready. And then that company that you hire to build your modular house is going to bring it out and set it in like 4 or 5 or 6 pieces, whatever. The shingles are already on, everything. At the end of one day, you have a house. Within the next 30 days, you have your general contractor finish it, right? But the risk is a lot less than having that builder do everything from start to finish. You can visit the modular company, you can watch them being built. It's a pretty solid deal. If I were someone who's never built a house before, I would build a modular house personally. You have to be careful because builders can really ruin your life financially. You can end up paying twice because if you pay them and they don't pay their bills, they can put mechanics liens on your house. It can be a complete nightmare. I've seen more divorce, more issues because people build a house versus just buying something that's existing. Imagine how frustrating it is just to get somebody to put a kitchen in for you now. Now imagine needing to pick everything and rely completely on one person to do that for you. So if you can get a good deal on land, make sure it has a water source that's there. A lot of times we see people looking at land where the well hasn't been drilled and the seller says, you have to drill your own water source if it's not public. Don't buy it. Make sure that the seller, make sure that that house has water, okay? Number one. Number two, if it has city hookups, make sure that that lot already has it. It already is a T going into the property that you can connect to. Because if it's land that isn't the case, where you got to bring the water and sewer line connection into the property, it may be out on the street. Now you have to check and see, is there any building moratoriums because of school overcrowdedness or something like that? Because I've seen people buy a lot in a county, they go to pull a building permit, they go, oh, there's a building moratorium, you can't get a permit. And you're going, wow, right? You didn't even know it. Now, if it already has that water and sewer line, chances are they already planned for the connection. You're not really adding to density that they already haven't permitted for. They could still stop you, but it's less likely than if you're going in to get a water and sewer connection. They may not be giving any more of those out. So a lot of things that come into play. And then keep in mind that if you are buying land, get a really good price on it, because you should be able to. They're not flying off the shelf like houses were ever. We weren't seeing that happen. We were seeing a lot of land getting priced up through the roof, and they're still available, most of those lots today, because builders aren't interested in them. Most builders aren't interested in a scattered lot. They want a minor subdivision where it's 3 lots at least, or 5, a major subdivision, 5 lots or more, because that makes it worth their while to be there and pay for any type of infrastructure. But anyway, I know this is great, man. We did an afternoon live stream.
This was fun. This was fun.
Thanks, guys, for joining us. You can drop your
today
comments below.
I was just going to say the news today was not necessarily fun, but it was fun being here with you all today. This was great.
Definitely. Yep, and drop your comments. We love to read them. If you like the video, you can let Melissa and I know. One of the ways you can let us know is you can hit the thumbs up. It lets us know that you appreciated the content, and we love you guys. There you go. Smash the button, right? The thumbs up. If you haven't subscribed to us, you can do so now. You can also share us with your friends. That's another way that you can help us out on this channel, is to get the word out to more people that need to know what's going on in the housing market. And our new website's getting ready to drop. I'll just plug that again, right? So we are really excited about that. A lot of you have been reaching out because you want agents in the states and the cities that you reside, and we can't help you because we're only licensed in Maryland. We have an amazing broker network. We'll be able to connect you with agents. I think he's trying to pull it up right now.
There it is.
Everything Real Estate's our new website. You want to scroll down through that thing a little bit? Here we go. So we've got maps that are clickable. But if you're not in Maryland, we'll show you not in Maryland. Here you go. Looks a little laggy. There we go. There's the map of the United States. You just simply hover over. You'll click on the state, and and we're gonna populate this thing up for you on agents that we know and that we know they have high satisfaction scores and that they're professional in the industry. So we don't want to point you to somebody where your experience wouldn't be fantastic. So we appreciate you guys.
Yes, thank you so much. And this was a treat, Todd. Again, hopping on this afternoon with you and with all of you as well.
All right, guys, we'll see you next time.
We'll see you next time.
Sachs Realty, Maryland broker number 607720, office number 443